I was going to ask you if the move from over 5% on the 10-year to now 4.44 has caused a change in thinking and your view of the market overall, because we are away from those sort of higher, scarier yields, which we didn't know what would do to the economy.
Right. And fortunately, they weren't there for long enough, I think, to have a significant impact other than through the equity market because of the much shorter reaction function associated with that. So I think back down at levels that we saw in advance of that spike up, which had a lot to do with positioning. Yes, it was an increase in the term premium, but it was a really mixed bag of reasons why you had that shoot higher in yields. Seeing that settle down clearly has been to the benefit of the market. But I think a more significant retreat in yields, if it's not sort of also accompanied by ongoing disinflation, could be a signal of a much weaker economic backdrop. And I'm not sure that's built into expectations. So I think we are at that point where it's more about lower volatility and stability in yields that would be most helpful for the equity market versus a shoot higher because of inflation reasons or a significant shoot lower due to much more significant concerns about the economy than what exists right now.
Meantime, Lizanne, now we're talking about central banks globally. I know Goldman says BOE may cut as early as March. Dollar's back below 104. I wonder what you think happens to the dollar if banks start to get in a race to cut, for example.
Well, there might be more of a race to cut and cuts coming sooner outside the United States. It was interesting listening to the conversation before I came on about the market and the Fed not really being in sync with the market expecting cuts to happen in the first half of next year, and the Fed still sort of pressing the higher for longer. Keep in mind that the Fed has been more, for lack of a better word, accurate in saying, hey, we're not cutting anytime soon. We have to remember that a year ago, the market was priced to expect the Fed would already be cutting at this point in the year. So those expectations have continued to be pushed out. And I just don't think we have the information to say, OK, high likelihood of a May cut, as Steve suggested. If you were to extrapolate the current set of circumstances, which I'm not suggesting you should, everything moves fairly quickly. But if you were to extrapolate the current set of circumstances, it doesn't justify the Fed pivoting from the most aggressive tightening cycle to actual rate cuts. It's certainly possible, but it probably only happens with inflation continuing to come down and maybe a bit more deterioration in the labor market. So I think there's probably more likelihood that what's priced into expectations outside the United States for what central banks are doing, because they're telegraphing it to a greater degree, I think that's going to happen more sooner than it is in the United States. And then that interest rate differential is I think the play on the dollar. For now, you've seen the dollar roll over because we've started to price in cuts, but I think that dynamic could change.
Lizanne, look, to just end on the broader market or market structure as well. I mean, our viewers have just seen the S&P performance for the year, but largely driven by 7 stocks, which are up some 94+% or something on average, and account for an enormous amount of the market value, given there are only 7 or 8 of 500 stocks. Right. What about the rest?
Well, so, I heard a comment the other day from somebody that said, the Magnificent Seven, the 7 best performing stocks. And I thought, well, that's not accurate. They're the 7 largest stocks. They're not the 7 best performers. They're all strong performers, but you have to go down to, I think, about the 35th ranking on a year to date to encapsulate all 7 of the Magnificent Seven. So there are other stocks that are working fairly well. If you do look at the S&P 493 or you look at equal weight, and then you try to see where leadership has resided and where the laggards have been, yes, there is a technology bias to leadership, but really where there's been the most consistent leadership is at the factor level. And in particular, quality factors like strong return on equity, lower volatility, and in particular, strong interest coverage. And if there's one fundamental supporting the Magnificent Seven as such a big driver, is that if you looked at those 7 stocks and considered them like they were their own sector, first of all, they'd be about 30% of the S&P, so wow. But they would have the lowest interest expense and the highest interest coverage. So if you did want a fundamental to point to, that would be it. But that's also the types of factors that have worked outside of just those names as well.
Lizanne, is there a sector that you like right now, or are you still sort of sector agnostic, going to quality in this kind of environment where the economy's slowing, but with the Treasury rally, market likes it?
Yeah, we think there's maybe some interesting opportunities within energy, even financials. I think you have to be pretty picky in materials, but we do continue to think that for most investors, stock picking oriented investors, they're better served focusing on factors and applying that screening and analysis across all sectors, because there are opportunities within all sectors. So, there are the quantitative work that our folks at Schwab Equity Ratings do have some mild biases, but we're still emphasizing that factor-based work.